Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Prerana, Seth, Fixed Income Strategist. With an objective to empower you with investment insights, on this program, we discuss various perspectives that are shaping the global investment landscape. Continuing with our fourth quarter outlook series, today we discuss about the fixed income outlook as well as the currency outlook. Starting with fixed income, global bond markets experienced a challenging third quarter with the Fed pressing on its higher for longer narrative, while US growth outperformed. The recent bout of bond market underperformance was spurred by US Treasury yield curve bear curve steepening, driven by higher long-term bond yields, while short-term yields have remained anchored. Long-term bond yields have been mainly driven by higher real rates and increased term premium, whereas forward inflation expectations have been fairly stable. This bear steepening is rare at this current stage of economic and Fed rate cycle. Hence, we expect the US Treasury yield curve to mostly bear flatten till the last Fed rate hike and then start to bull steepen subsequently. While bond market volatility could continue until the markets get the timing of the last rate hike, but we expect limited upside in long-term yields from the current levels. Overall, we remain underweight on global fixed income, underweight on developed market sovereigns, but we maintain our preference for 7 to 10-year US Treasuries. Past 6 Fed tightening cycles have shown that the 10-year US Treasury yield tends to peak before the final Fed hike of the cycle. Elsewhere, we are overweight on emerging market local currency IG and underweight on emerging market corporate IG. We remain neutral on developed market corporate IG, emerging market dollar sovereign IG, and global high yield. Moving on to currencies, the US dollar has been one of the best performers compared to other asset classes and witnessed a strong summer helped by resilient US economic data versus the peers. We expect the US dollar to remain strong in the near term and end 2023 at year-to-date strong levels. Firstly, US growth outperformance should continue while growth underperforms in the Eurozone and in the UK. Secondly, Fed may sound hawkish now compared to other central banks, thus keeping that interest rate differentials wide. And lastly, our expectations of bear flattening of the yield curve should support the US dollar. Having said that, the possibility of the US dollar returning to 2022 high levels is also low for the following reasons, and we expect that the strength should fade in 2024. Firstly, we are in the last phase of the Fed tightening cycle, and historically the US dollar tends to peak before the last Fed rate hike. Secondly, US growth differential with peers should start to normalize in 2024. And lastly, our expectation of bull steepening to begin somewhere in the first quarter of 2024, and during periods of bull steepening, the US dollar tends to underperform. Elsewhere, we expect the euro to remain under pressure at least till end of this year. We are also negative on the GBP in the near term, and we maintain our negative outlook on the Japanese yen as well. As always, thank you so much for listening to our podcast. We hope you find it useful. If you do, please share it with your family, friends, and colleagues. For more information, please reach out to your contact at ADCB. You can also log in to our website www.adcbam.com. This is Prerana signing off.